investors. I'm Stuart Cruz, and welcome to Cruz Asset Management's quarterly recap. We are recapping Q1 of 2021. We've got about 90 days in the books. We're going to look at how we've done so far, what we think is going to happen in the future, some portfolio moves you think you should make. Today is April 20th, also known as 420 or Cannabis Day, and I literally have snow outside my window here in Chicago. I guess that's what I get for living here in Chicago. But without further ado, let's jump to the charts from our friends at White Charts and take a look at what we have on the screen. Right now we have the S&P 500 up through the first quarter, and we're up 5.7%. Great return for one quarter, especially when you're coming off a pandemic. We had positive returns in a global shutdown, and we already are up 5%. So that is a monster return in one quarter for a rebound. But what are some trends? If we've looked in the past, growth has led the way. And if I put a growth ETF up there by our friends at Schwab, we notice that growth is underperforming, only up 1% year to date. But value, of course, is the other side of that coin. They are doing well, up almost 10%, 9.66%. Now, traditionally, whenever growth has outperformed value, as it has done for the last several years, value has been the winner and has traditionally been the winner over the long term. So we believe this trend of value outperforming will continue, and we'll tell you a little bit about why that is moving forward. So let's look at some other indexes. We have the international markets that are up basically in line with the S&P 500. Let's take off value and growth off of these charts so we can see the S&P versus international. They're pretty much right in line. And if we look at emerging markets, which has done well in the beginning and kind of trailed off, we also feel like emerging markets are at low multiples. So that might be a place that you want to put some money to work. All right. So we're going to switch gears here a little bit away from equities and jump into fixed income. So right now I have the 10-year Treasury note up here, and I'm going to switch it to the absolute value. So you can see in the beginning of the year, we were basically at about, let's see where we're looking at. We're looking at 93 basis points here, and we have jumped up to 174 basis points. It's almost a double. Prior to that, of course, if we go back, I'm going to go back a full year, we can see we are down to 52 basis points about right here. So we have tripled since then. So as the 10-year Treasury moves up, what that means is companies that are relying on future growth, their multiples should contract because you're basically operating on a discounted cash flow model, right? Future earnings are not as valuable as current earnings are today. So I'm going to jump back to a one quarter chart, and there we can see how the 10-year Treasury has been moving up. So interest rates are moving up, and I'm going to add the S&P on there for reference. As we know, it is up 5.7%, and let's look at some fixed income. So we know the 10-year Treasury is moving up, and when Treasuries move up, that means bonds and the prices of bonds go down, and that is reflected by our corporate bond ETF, which is down 3%. If you want to look at junk bonds, which often has a component of equity to it, they're flat, so underperforming the S&P because of the drag on the bond component. Convertible bonds convert to equities, also underperforming. And let's take off the 10-year Treasury so you can kind of see how these numbers look. The purple line is the S&P 500. We've got the ag that's underperforming all of them. We've got junk bonds and convertible bonds also underperforming. And if we look at the TIPS, which is an inflation-protected note, that is also underperforming. So given the rising interest rate environment, fixed income is down, and we expect that to continue to flow like that. Now let's take a look specifically at TIPS themselves. And I'm going to just look at TIPS. You can see they have sold off, and let's look at the original price or the actual absolute value of price, and the TIPS have come off, and I'm going to look at them over a 3-year window. You can see TIPS have moved up quite a bit over 3 years, and over a 5-year window we're down, up, up, up. So we feel like we've gotten about all that we can get out of TIPS right now. We hit a bottom back in 2018 and have rallied strong since that point. and we just feel like we are running out of juice with Treasury inflation protected notes. So we'll probably reduce, if not eliminate, our exposure to TIPS altogether. All right, now let's shift to some alternatives. And here we have some alternatives up on the screen. And let's make this a little bit more reasonable here. Again, the S&P 500 for a reference point. We have the S&P up 5.77%. Gold has been getting crushed, down 10%. Now, usually gold is a fear index, so if people feel like the economy is doing worse or they're concerned, gold usually rises. This is not what we're seeing right now, so the sentiment is out there that gold is doing well, or that the economy is doing well, or is going to be improving, which is why gold is off. But that said, commodities are up. So with rising interest rates, if you're going to have rising interest rates, you want to own things that are inflating with inflation, like commodities. And I'm going to add on here some real estate. Let's look at our friends IFC, Cones and Steers. So real estate has also done well. So in spite of a rising interest rate, you have an underlying real estate component that is going to be rising with inflation. So if you want to protect your purchasing power, you need to have things that are going to inflate with inflation. So that would indicate commodities and real estate, in spite of the fact that gold also follows that. Gold is falling off because it's just not taking care of the, or it's just not getting that boost by the fear index. And of course, what alternative chart would be complete without our friends at Bitcoin, which make all these other returns look dwarfed, because Bitcoin is up 100% in this first quarter. It's sold off considerably over this last week or so, but still phenomenal returns of Bitcoin. All right, so where do we go from here? Well, let's go back to our charts here, the S&P 500. We are looking at a 10-year note, and you can see this S&P has been on a nice move forward. But let's look at the S&P 500 PE ratio. And you can see over the last 10 years, the average PE ratio is 20.4. Now that's considered to be a pretty high PE ratio in general. And if we look even before this, back in here, you're probably looking at the 15s. And if we wanted to, let's say, let's go back to 2007. Oops. Let's go back to, 2007 and 5. So we can kind of see what happened with that dip of the PE ratio. Well, we had earnings that fell off the map. But here we have a PE ratio that's a little bit more normalized in the 15s, 13s range. Here you get a huge spike because if your earnings basically drop to nothing and your price stays relatively the same, then the PE ratio skyrockets. So clearly this is unsustainable during that market meltdown in the financial crisis. But here we have a PE ratio of 13, and here we have a movement up. So if we go back to a 10-year note, or 10-year range, we see that this is, again, relatively unsustainable, mostly because the earnings have dropped off, and the market's giving it a pass so we can look through this. But if I add this 10-year Treasury note onto this PE ratio, you can kind of see how the 10-year has bounced back and forth between, we'll call it 3% and maybe 1.5%. But more recent times, it's dipped down well below that number. And it's coming back up to the bottom. So what that would indicate to me is we're going to have a return of back to this kind of range of our PE ratio. So here we are looking at a PE of 39 or 40 when the average has been 20. So we're about twice as expensive as where we have historically been. Now, our earnings are off, and we're expecting earnings to grow into, or our earnings to grow into the PE ratio to some extent. But as that interest rates continues to climb, you're going to get more PE compression. And I think that example can be shown and illustrated more cleanly with our Apple stock. So Apple, a phenomenal company, $2 trillion company plus, and you can see it's been on a meteoric rise. But if I add Apple's PE ratio onto here, and you can see at the bottom chart, it's trended around 17 on average for a long period of time. It's trading at more than twice that. And if we add the 10-year Treasury onto this, you can see the 10-year Treasury, when it's been trading between 1 and 3, Apple was trading at around 17. When it dipped down below, that's when Apple started to spike up. When the 10-year Treasury started to come back up, Apple started to trade down. The PE started to trade down. So am I telling you that Apple's going to get cut in half? Well, I'm not going to tell you that, but if you're just looking at, and I'm going to take a look at revenue, annual revenue for Apple. So it's been growing. So over the last 5 years, Apple's revenue has only grown at 27%, while its PE ratio has more than doubled. So I'm going to put the PE ratio back up on there. Its PE ratio is up 205%, while the growth of the company, the top line revenue, has only grown 27%. And that's possibly because the 10-year Treasury rate is off so much and it hasn't rebounded yet. So could I see some pullback in Apple or all the other tech stocks that are depending on future growth? Absolutely. That's why we believe value is the place to be over growth for the near future. We want to be in equities versus bonds because we're in a rising interest rate environment. And we want to be in asset classes that are going to inflate along with inflation, like commodities and real estate, and not gold because the economy looks like it's better off. All right. So what have we been doing in order to combat some of these possibly stagnant issues that we're going to have? We've been buying some structured products for some of our clients. And if you're not familiar with structured products at all, we created an explainer video that we have a link down below. You can click on it. It's a very simple explainer video of the basic principally protected structured notes, but there are all kinds of structured notes. And what these things do is give you a structured payout. So if we don't believe there's going to be meteoric rise from here, given the high PEs and a rising interest rate environment and a challenging environment for equities, then maybe we start taking a slightly different approach in order to make our clients some money. Either we use principally protected notes or income generating notes or dual directional structured notes so that you can get a payout in both up and down markets. All right, so this is Stuart Cruz with our quarterly update and reminding you and trying to help you to invest and live your life with the odds in your favor.